Good morning. Supply chain management is supposed to be boring. When the system is working, either for a company or for an economy, nobody really even knows it's there. But when stresses come, or when major unforeseen events hit markets, the system can break down, and products may be available only at prohibitively high prices, or maybe not even at all. It was widely expected that the new Trump administration would announce new tariffs on imports, and especially imports from China. And supply chain executives planned accordingly. But the size and the scale of these new tariffs were not expected. So supply chain managers, inventory management executives, logistics companies, they deployed other tools to buy them some time and put off the big price increases that would have hurt their customers and their companies. Just in time is famous in manufacturing industries. It's what made Toyota rich. And Toyota's super lean parts ordering and manufacturing process dramatically sped up everything for them while cutting costs. JIT has been copied by almost all the major manufacturers of capital equipment, but just in time is much more important in inventory management for retailers and warehouse managers who use JIT to keep their costs low. This is all a careful balancing act. In previous years, retailers used a just-in-case approach. If a customer walked in and wanted something, we needed to have it in stock just in case. We don't want to lose a customer. But then companies got very good at predicting what customers will want and predicting exactly how many of each product would be in demand over the short term. Better global logistics and the air freight industry made it even easier. Merchants could place an order and have it arrive the next day from anywhere in the world. Better demand forecasting and global logistics that allow for next day delivery made just-in-time inventory management possible for businesses everywhere in almost every industry. The pandemic screwed up all that. Consumers around the world were not even allowed to go outside, let alone to the mall. That was the demand side. The supply side was just as bad. Container ships were not being loaded in Asian ports, and when they did, traffic jams formed outside our ports. There was a supply shock followed by a bullwhip effect, which blew up supply chains all over again. Eventually, things settled down, and by last year, companies were feeling more comfortable and moved back toward JIT systems. The focus is on reordering and shipping, replenishing products instead of stocking product. This is the most important chart for warehouse and supply chain managers. The inventory to sales ratio shows how much merchandise is kept in warehouses available for sale. It's the value of inventory divided by monthly sales. These are monthly numbers then on the y-axis. During the pandemic, it collapsed to 1.15. 1.15 here means 1 month and 4 days. So about 35 days of inventory available economy-wide. Then came the glut as ships were full of merchandise that nobody wanted anymore, like exercise pants and home gyms. So it went up to 45 days or so. Now it's trending back to the recent historical trend, 1.35, which is about 40 days. These do not seem like big differences, but they are. It costs a lot of money to build a warehouse and staff it, or to lease a warehouse and then hire security and the people to move merchandise around. Insurance against fire and theft. Obsolescence is a major problem, especially in electronics and fashion. Big, bulky items take up a lot of space, and they're usually low profit margin as well, which explains why there was a run on toilet paper, and stores literally had none of it sitting around. You don't want an expensive warehouse full of cheap toilet paper at 15 cents a roll. The difference, economy-wide, of that 5 days difference is tens of billions of dollars a year in cost savings. Companies are now able to predict shopper demand and fewer supply chain disruptions. And that first part is true, but supply chain disruptions are by their nature unpredictable. Wars, major storms, piracy, major policy shifts, pandemics. But what is predictable is the cost of keeping merchandise that does not sell, or which will not sell for 2 more months. Those costs are knowable, and inventory managers are paid to keep those costs down. So last year they were cutting inventory levels. Major retailers like Walmart updated their forecasting and shifted to smaller shipments. They can predict lead times better, and Walmart was cutting inventory even while they were growing sales. These new tariffs are now driving the cost up a lot to bring new products in. It's also become pretty risky to do so because as a merchant, you don't want to place a large order and pay a high tariff and then have it go away. You will wait unless it's something you must have and that you know you can turn at a large markup, which includes the tariff. So there is a lot of uncertainty, which is putting a big dent in production from factories that build for the US markets. But wholesalers and major retailers have a way around that somewhat. And this is the second powerful tool that they have. Here is a map of foreign trade zones in the United States. By taking delivery of products inside an FTZ, merchants can postpone the payment of tariffs. An FTZ is considered outside the taxable jurisdiction of U.S. Customs. Tariffs and duties are not paid until they leave the foreign trade zone and then are either sold or used outside the FTZ. Importers using a warehouse in a foreign trade zone have a choice of paying tariffs in whatever way is most advantageous to them. Typically, the facilities are just warehouses, which are designated as part of the free trade zone. And this map is a little misleading because the areas designated as foreign trade zones are enormous. This is a map of North Carolina. The gray areas are the parts of North Carolina that are not considered part of an FTZ. Just one foreign trade zone in Illinois takes up half the lower part of the state. For a company with its own warehouse, it costs just a few $1,000s to apply for an FTZ designation for that particular location. And then the company can import merchandise without paying tariffs by putting it into that particular warehouse. When he takes product out of the warehouse, either to sell to a buyer or to use himself, that's when the customs tariffs are paid. It was worthwhile then for companies to stock up their own warehouses in foreign trade zones or to use a third-party bonded warehouse to store their products. And then when the tariffs came down, they would have goods ready to sell. And that is exactly what they did. Those warehouses in our foreign trade zones were filled up. And we got news from Canada that companies were routing shipments there to stockpile goods instead of in warehouses at home. 50% of consignments outbound China for the US were sent instead to Canada in April. Amazon and Walmart are the big names mentioned in that report, and their strategy was to wait until the tariffs fall before releasing them to the market. In fact, companies told some of their suppliers here in China to resume production after they forecasted correctly either that the tariffs would fall or that demand would resume despite the higher prices. With the news of these steep reductions in the tariffs, this was a high-risk and high-reward gamble that paid off. It did cost these companies a lot of money to fill up their warehouses across all these foreign trade zones, then fill up a bunch more up in Canada. Had those very high tariffs stayed on at 145% or more, these merchants soon would have faced customers looking for products that are not available on their shelves, but which are sitting in a warehouse just down the street in a foreign trade zone. And at 145%, they would have had some painful decisions to make as to what the retail prices should be on products they pull out of their warehouse at 2.5 times the factory costs. Then, whether to reorder new inventory to restock product from those sales. Now the tariffs are 30%. A 30% tariff is still very high, and taxes on these Chinese-made goods will still be a hard hit to their demand, and managers will still have some hard decisions to make. The good news is that they have the products. The products are there right now, available for sale to their customers. This is the Tai Po Highway in Hong Kong. Be good.
political leadership on this earth, the bosses and managers in our companies, the mayors and police in our towns, the governors and kings and presidents. We ask for a revival in this part of the world.